Good. Let's get going, I think, because we've got Andrew on to run through what's been going on over October. And we've also been talking to Manesh Shah, who's the manager of Renewables Infrastructure Group. So news-wise, there's not a huge amount. I thought about Troy Income and Growth. So they've basically said that they're looking at potentially merging with another trust, but there's not much detail on it. All they've done is suspended the discount control mechanism for the moment. So that's probably not worth having a look at. I think that's all right, and we've talked to them before, I think. You can always go back and have a look at that show if you're interested in them. But the one I wanted to talk about today is RTW and Arix. Arix is a fund, but it's not a fund that we normally look at. So it's not on any of the Morningstar stats. It's not a member of the AIC. And I think that sort of means it's been slightly neglected. With most of these biotech things, you can see I wrote a City article about it week before last. There's been quite a sort of long bear market. It's actually predated the interest rate rises, but it's sort of carried on going since, and there's not much sign of recovery yet. But I think that just means it's all quite oversold. So anyway, so Arix is sitting there, and then it's still on a sort of 36% discount even after the news of this week. About 150 million market cap, so a reasonable size, and obviously the assets-wise are much bigger than that. That's RTW's share price, which I think is probably the class act in this bit of the market, but its discount has opened up, as we know, and there it is there, currently about sort of 30%. And it's actually been dipping recently, and that's part of what I want to talk about. So this was all triggered by Arix announcing a strategic review back in July, and they said there was a whole load of options on the table. The sort of hint probably was that it was more like to do kind of some kind of wind down, but actually RTW came along. I don't know if it was the only one because there's no news on that, but they offered to do a kind of some kind of merger. It's obviously been triggered by the discount, so that was about sort of 47% on the 12th of July. The share price was 98p. Then the market cap was only 126 million, so even less than it was. And that looked really weird because they had cash on the balance sheet of 101 million. So yeah, the actual sort of discount on the investments was enormous by the looks of things. The way this deal is going to work, as usual, we talked about these before, they're all kind of Section 110 schemes where you basically liquidate one company and then merge what's left into the other one. And this one, Arix, is going to be the one that's liquidated. The deal's been recommended by the Arix board, and they've all said they're definitely going to vote for it. And it basically boils down to that sort of fixed ratio of RTW shares for Arix shares, which before they announced everything, valued Arix shares at about 143p each. Versus sort of 98p pre-announcement, as we said. But because the RTW share price has come down since, that's now about 130. There's a kind of wrinkle in all of this in that there's one big shareholder in Arix, this Arcadia Research Corporation, which is a New York-based investor, not remotely connected to anything else as far as I can work out. And they have a 25% stake. So RTW is actually going to buy that off them in a subsidiary. They're paying cash for that, which will cost them about £47 million, and that will complete around the time all the rest of the deal happens in Q1 2024. One of the things that RTW's negotiated is that it's going to get the management contract for Arix, regardless of what happens with this, and that, I suppose, is ticking the box for it, so its assets under management will grow whatever happens. But if they can knock the two together, there are obvious kind of scale advantages. So they mentioned things like liquidity and overall cost being lower. Maybe they'll get to an index, and they're also hoping that this thing, that bigger size, that more people can be interested in the market, in a bigger market cap company, and this will be a re-rating opportunity. We'll have to wait and see for that. And then RTW also gets some free cash. That's some of that cash that's sitting on Arix's balance sheet it will be able to use to fund new investments. So we know RTW is a decent thing. We've talked to them before. We remember we had Stephanie Soros on a couple of times, and it's done very well. It's got a very good track record. It's got quite a big team, much bigger than the Arix one. It's looking at deals all the time, and so it should be able to deploy the cash that Arix has got quite quickly. And one of the things that it can do is put it into royalty funds that just generate some income as a way of sort of parking cash temporarily. It might also buy listed stuff. So this is the Arix portfolio, just a top line view. So it's a mixture of listeds and unlisteds and cash. So that cash will be reduced by the effect of the 25.5% deal. So that shrinks it down a bit. This is what the RTW portfolio looks like. So it's got a mix of what it calls core listed, which is its things that it really likes, and then the other listed, which is where it's parking cash to give it some exposure to the market. And then it's also got some royalties. So it's actually got a lot more in listeds and cash-like things, and relatively small amount in unlisteds relative to Arix. So when you knock those two together, the fund becomes about half listed, and then you can see the breakdown there. Now, I've done the maths. It doesn't add up to the NAV that they said they're going to have at the end of it. I'm not quite sure why. I'm not going to get too bogged down with it. I spent ages looking at this morning. I couldn't work it out. But I do reckon, because obviously the cash for the 25% stake is going to effectively come out of Arix's cash. I mean, one way or another, which it's obviously quite attractive for RTW. This is what the combined portfolio looks like. And the ones in the darker pink are the ones that are coming across from Arix. So it had generally bigger investments in things than RTW does. So slightly more concentrated portfolio. And so that it is going to be important that the RTW guys have had a proper look at this, and they're all happy with these. And assuming they are, otherwise they wouldn't have gone down this route. There are some interesting things in there. We know the story with biotech. It's all really driven by can you bring a drug to market? They've got a lot of stuff that's in sort of phase 2, phase 1 stuff. This disc medicine thing, it was a big contributor to Arix's NAV this year. So it just raised some money to fund its trials, and that pushed the share price up quite a bit. Yeah, so I think this is really quite an attractive thing. They've got the royalty funds there for RTW as well. And as I say, they're probably going to park some money in there for a bit, so that will help them. And then it'll end up relatively concentrated, but with a much longer tail. And then we'll see what happens, how they move the portfolio around after that. So in conclusion then, I think this makes sense. I think of all the things that Arix could have done in terms of preserving the assets within the investment company structure, this was the most obvious one to do. It might be that there are merger arbitrageurs getting involved in this, and they're the ones that are driving down RTW's share price. At the moment, it still makes sense, obviously, if you're an Arix shareholder, to accept the deal. And remember, if you're exchanging shares for shares, and the RTW discount is temporarily depressed, then when all that gets sorted out, you'll benefit as that discount closes again. So although it's a slight leap of faith, I still think it does make sense. What we don't know is what is going to happen to that lot of RTW shares that are going to be issued in exchange for the Arix shares. And so they will be held within a subsidiary. So effectively, they'll be like treasury shares. It might be that RTW is able to place those. Again, we're going to have to find out what the mechanics are of that. That's something to ask people. I could get my head around being okay with them placing those at 143p or higher, so still at a discount, because effectively, well, they could benefit from the uplift of just cancelling them. So I think it sort of works, but we just have to wait and see. What we don't know is what the costs are They'll be in the circular. That's going to come out before the end of the year. I'd like to see RTW making a hefty contribution to costs. That's what's the normal thing in these circumstances. We're just going to have to wait and see on that. And then, provided that all the relevant shareholder groups approve this, the whole thing should be concluded in about first quarter of next year. So somebody's saying, if I don't have an interest, what would you buy, RTW or Arix? Well, at the moment, you buy Arix, assuming that you're fairly confident that this deal is going to go through. Of course, if it doesn't go through, RTW will still be managing the fund, but presumably it'll end up in wind down mode. But that's uncertain. So that's the only sort of wrinkle with that. But in terms from a sort of purely mechanical point of view, in terms of where the maths are, you buy the Arix shares. So that's enough from me. But before I go, I know Andrew's keen to take over. There's another question about capital gearing's resting its discount control mechanism. So basically, because its performance hasn't been great and it's actually lost you money, it has been shrinking, and it's running out of distributable reserves to be able to support its share price. And so it needs to go to the courts. It's a Northern Irish company, which is quite unusual, but it is. It needs to go to the courts in Northern Ireland to get approval to buy back more shares, and that's going to take about 3 months. I think it's going to run out of buyback capacity really quite quickly, so the discount could widen. How much it widens, though, I don't know. If it does, because presumably all of this will just get rolled through in the end, then it could be a buying opportunity to get into capital gearing. But there we go. Anyway, that's enough for me. Let's talk to Andrew.
Great, thanks very much, James. It's nice to see with RTW that it's actually a trust expanding, because most are going in the opposite direction. So there we are. Good. Let's have a look at what's been going on. I thought I'd just start actually with a couple of general slides about the sector before moving on to the movers, and to have a look at what's happened so far in this calendar year, which overall has felt quite challenging, let's say, and has been very difficult actually for the past 3 months or so. But actually yesterday we did see a very big bounce actually in the sector, which has continued a little bit this morning. And clearly we don't know whether that is going to continue or not. But what I think it does mark actually is that there's been quite a bit of volatility of late in both directions. And I think that kind of market choppiness does sometimes indicate that the market is looking for its direction, which hopefully will be a change of direction in our case. So fingers crossed. Certainly in terms of the opportunity for uplift, it's not just about rising NAVs, it's about the valuations as well. And this is a chart from Winterflood that just shows the evolution of the discount in the sector over the last year. It's been overwhelmingly negative, of course. And the average discount now is 18.7%, clearly much wider in the alternative space than in the equity space. But nevertheless, I think that indicates some opportunity here. And the other chart I'd just like to remind us of, which I have, I think, shown before, is a much longer term chart of the discount, which was produced by Numis earlier in the year. And I've just put on the thin red line to show where we are now. And I think what this shows is that actually over the last 30 years or so, it's only been worse on one occasion, which was during the credit crunch, which was clearly a crisis of a far greater magnitude than anything we're going through now. But the other point I really wanted to make, which is why I wanted to show this again, is that on previous occasions when the discount has come off its lows, it's tended to bounce actually quite sharply. And I think that's really in line with my expectation with what might happen in this market, that actually when the turn does come, it may come very quickly and be quite sharp. So my approach has been very much that you need to be in the market rather than waiting for it to turn. Again, I might be completely wrong about that, but that's how it seems to me. So actually, during October, there weren't a huge number of attractive gains, but some interesting ones on the list, as always. I should point out Digital 9 infrastructure, which we've talked about before, and probably that was driven considerably by James saying he was buying in. But it's been, a decent recovery over the last month for that, and hopefully has further to go. But I think the things I would take from this list, there's two really. One is aircraft leasing, which is a very specialist realm, but it's actually been doing very well of late. And the other, you can see overwhelmingly from this list, actually, quite a significant number of REITs have bounced from their lows. So I'll just talk about those as well. So aircraft leasing, first of all, I did talk about shipping last month, so I feel I'm working my way through all of the transport sectors. This is not something I've really covered very much in my newsletter because I've always felt it's quite difficult to understand, and I've never been really certain I've had a good grasp of it. To me, it seemed it's really all about the underlying health of the aircraft and travel industry. And this was a sector that was really clobbered by the pandemic, as I'll show you in a moment. And now it's actually seemingly recovering very strongly as the travel industry is quite strong. And there's a lot of demand for new aeroplanes, actually. But that's being met, actually, with quite a lot of supply side difficulties, which is the supply chain problems that we've all come across with cars and other things that require a lot of electronics. And there was a piece in the FT last week about this and about how the leasing rates for aircraft have really been shooting up, but also that airlines have been increasing the length of leases. So they've been renewing leases where they've been expiring. And that's really crucial for these investment trusts because they have fixed term leases with major airlines. And then the idea is that you then, at the end of those leases, you try and sell your aircraft for whatever it's worth in the market. And that's the great big unknown with this. But now we are seeing the potential for those leases to be renewed, which means a longer income stream than originally envisaged. And the rates are very good. So this is very helpful for Doric Nimrod 2 and 3 and Amadeo Air 4 Plus. But I'm still I had a good look at them actually, but I still struggle to understand them properly. And I think this really is a very specialist area. So if you are thinking about it, you really need to make sure you've done your homework and you understand the leverage and everything else involved. But it does look interesting. This is a 5-year chart. It shows you actually those three trusts that really fell very, very sharply in the pandemic for obvious reasons. Aircraft weren't being used and the airlines were having financial difficulties. So Thai Airways was one of those, which Amadeo leases to, and they were having problems paying those lease bills. And that really matters. That's why the performance of these three trusts is not exactly the same because they have different aircraft leased to different airlines. So again, you really have to look at them very closely in a granular way, I think. But they've done quite well of late, and I think we'll probably see a bit more volatility in those prices to come. The REITs now, which I think is probably quite a lot more mainstream, and many of us will own some of these. I'm quite hopeful that this sector is establishing a bit of a floor at this level. Inevitably, some things have bounced a bit more than others, and I think that's to be expected as people analyze the individual portfolios. But fundamentally, I think the driving factor here of paramount importance is interest rates. This is obviously the most sensitive of all sectors to interest rates. And yesterday's news from the Bank of England that they were holding them steady, I think was quite reassuring. And generally, the tone seems to have improved there. And I think this month's inflation figures will show a big drop in the inflation rate, coming down to around 5% because of lower energy costs. and that's going to help sentiment as well. So it could be that we're starting to build a base here from which these trusts can start to recover. But right now, there's certainly many wide discounts and very attractive yields on offer. I've listed a few on this chart. One interesting one there, which actually I was just thinking about as you were talking, James, about RTW parking their cash. One place you can park cash, actually, quite interestingly, in the REIT sector is UK Commercial Property REIT, which is a very large liquid trust at the more conservative end of the market. It does have a very narrow dealing spread. It's very liquid. And interestingly as well, no stamp duty payable on that one. So if you are parking any cash, that's quite an interesting place to put it. That's had a good week, actually. And most of these trusts have. But the figures still look very enticing, I think, if you're prepared to take on the risk. There is one on the list there that actually has fallen over the last month. And it's a puzzle to me, actually, why. And that's the Aberdeen European Logistics Income, which has been weak. I'm not sure why, because actually in the UK, Tritax Big Box and some of the other sheds have been coming up. But anyway, the discount of 45% and the yield of 9.4 looks quite interesting to me. So that is on the list of fallers, actually. Aberdeen European Logistics Income, beg your pardon, and down 17% over the month. So it had a pretty chunky fall. But actually, that's, I think, probably the only REIT on the list. And for me, actually, the sectors that are more interesting here are growth capital and renewable energy infrastructure, both grouped rather neatly there. So I'll just talk about those two. The falls in growth capital have really been quite considerable yet again. And I think essentially here, there are just no buyers. I mean, it's as simple as that. That these prices are ultimately determined by the balance of supply and demand, and there's just no demand. And I think one issue here is that there's no fear of missing out because these things have been so weak. And I think it's quite difficult to establish a floor here and a particular reason to buy. Unlike REITs and those other sectors that are offering you a yield where you can clearly see a rationale for buying at a certain level and you're getting paid to wait. That's not the case here. And so I think I can understand why buyers are a bit more reticent here about jumping in and being too early, which is definitely a risk. And I think something that I've probably been prey to. Nevertheless, I think what's interesting now is that these trusts do have plenty of opportunity to reassure the market and to show the market that their underlying fundamentals are still sound and making some progress. And we've seen this before, actually, with Hydrogen One Capital Growth, for example, when it announced its second quarter results, its interims, on 20th of September, it had quite a positive impact on the shares. Those are curiously volatile, those ones, and they do move, actually, when there are news announcements. So HGen has its third quarter results coming up on the 14th. And Seraphim Space as well has results coming up on the 20th. It'll be interesting to see. Last time, both sets of results were actually pretty sound, I think. And I think if those trusts can do the same again, then they may persuade investors actually that the underlying fundamentals here could be worth backing. That's my view. But certainly, I think there's scope for a bit more corporate action as well. So I was interested to see the Schiehallion Fund starting a buyback program, which was unthinkable a couple of years ago when this trust was trading on a big premium and was just trying to cope with the demand for the shares and issuing more and more. So things have changed. And, I think most trusts in the alternative sectors now have either instigated buyback programs or are thinking about them. So, this is a new thing. In my opinion, I think these trusts, which actually do develop quite a lot of news flow for themselves because they're doing deals or they're getting news from their underlying companies, there's a bit more scope for them to update the market more frequently with that good news. And I've noticed in the REIT sector, for example, some companies are being a bit more canny about their PR now, and they're being a bit more granular with their news announcements so that when anything good happens, they tell the market just to try and help the share price. I noticed Regional REIT had a major letting actually this week, told the market, and it really helped the shares because sentiment is so depressed that actually I don't think it takes very much to have a turn. And I think the scope for these growth capital trusts to do the same thing. So we'll see anyway what happens with Seraphim Space and Hydrogen One with their results. Finally, I'm not going to say too much about this because my opinions are going to be trumped very shortly by Minesh, who has far more knowledge than I do of this. I'm sure Minesh will be greatly encouraged that I don't think renewable energy is going away anytime soon. There are these massive tailwinds. In view of the weather this week, they're tail gales, I think, really. The US Inflation Reduction Act is a huge bit of legislation that is backing this sector. And as well, much as markets are depressed by the news from Ukraine and in the Middle East, actually, these conflicts really do put the pressure on governments to think even more about the security of their domestic energy supply. And that, again, plays into the development of renewables. So these factors, which I think are going to be sustained for quite some time, are not going away. And I did see quite an interesting piece of information this week from JP Morgan Cazenove, who calculate these steady state returns on renewable energy trusts, which basically tell you what the annual return expected for shareholders is if the cash flows just come in as forecast. So they're not forecasting any shift, any uplifts, any growth, just if they come in as expected. And those steady state returns are actually very attractive. So for the two digital infrastructure trusts, they're just over 15%. And then actually just below those, there are some very attractive returns from some of the higher quality renewable energy trusts, such as JLEN Environmental Assets with 13%. And so, I think there's plenty of value here. There are plenty of dividend yields that are actually hitting double digits now, plenty of scope for corporate action. And we've seen some attempts by certain trusts to try to improve their standing in the market, notably Greencoat UK Wind last week, which increased its dividend to 10 pence a share to increase the yield to around 7.5, and also instigated a new buyback program. So there's plenty of scope here for improvement from these current levels. And this is my last slide, just to leave you with this, actually. A lot of the figures are very enticing. You can see in the yield column, there are actually quite a number here that are in double digits. And some of those are from trusts that have issues. So, clearly one needs to do homework as normal. But actually, even amongst those trusts, I think that are considered to be the high quality players, obviously including Renewables Infrastructure Group, you're getting yields of maybe 7 to 8% and discounts of around 20. So I think there's a lot of value here to be unlocked, and I should be very interested now to hear what Minesh has to say. So that's it from me. Thank you. Thank you very much.
Great. Thanks, Andrew.